So I think we are live. Thanks for joining the webinar on transfer price developments in for nice countries like Poland, Germany, Austria, and the Netherlands. We will take you through those countries and the TP developments in around 1 hour. That will be a challenge with all what can be said about the countries and the slides we prepared, but everybody will get the information, the slide, and can have a link to the recorded webinar that will be, I think, sent to you after the webinar. I am Theo Elshoff, manager of the Quantera Global, and founder in 2013 with a couple of partners. We're fully focused on transfer pricing, from strategy to up to automation and operational TP. And we have a global network of partners, and I'm very happy that we can do it today with Arthur, Jakub, Klaus, and Oliver. For Poland, they will start Arthur and Jakub. Klaus and Oliver will go to Germany, and Oliver more in Austria. And I hope in the end that they leave some time for me for the Netherlands. And I introduced already myself. I think the speakers can introduce themselves and they go into their part of the webinar. And at first I would like to ask Arthur and Jakub to take the part for Poland, and maybe a small comment in the beginning. It is always nice to see that culture and focus of a country also influence the transfer pricing developments. So please, Arthur and Jakub for Poland, would be great to hear from you what is happening in Poland.
Yes, hello to everyone. My name is Jakub. I'm a part of another advisors. Today, Arthur and I will talk a bit about the transfer pricing regulations in Poland. I will start with the compliance obligations and penalties for non-compliance, and then Arthur will take the floor to talk about the new controversial regulations regarding tax havens. Next slide, please. So Poland introduced three-tier documentation approach in 2017, but these obligations were much more aligned with the OECD guidelines in 2019. So starting with the first tier, those are the obligations regarding the controlled transactions, and those obligations appear if certain thresholds of the controlled transactions are above them. So starting with the financial and goods transactions, if the value of the transaction exceeds 10 million zlotys, and for the services and other transaction, this is 2 million zlotys in a given year. So we've got 4 parts of those obligations regarding controlled transactions. Those are local files, including obligatory transfer pricing analysis in the form of a benchmarking study or a compliance analysis if the benchmarking study cannot be prepared. We've got also the TPR form, which is unique for Poland. This is kind of a declaration that is submitted to the tax authorities. This is a general information on the controlled transactions, which include the value of the transactions, the level of the prices applied in the transactions, the mechanism of calculating the prices, and what is important, also the results of the transfer pricing analysis. This is an instrument that is used by the tax authorities in order to indicate the taxpayers for tax audit. And the last obligation relating to the controlled transactions is a statement that is submitted by the management board to the tax authorities. And within that statement, the management board members state that they have prepared transfer pricing documentation local files, and that the documented transactions have arm's length prices. Next slide, please. And further going to the tier, second and third tier, those obligations appear depending on the consolidated revenues. If the consolidated revenues of a group exceeds 200 million zlotys, the taxpayer is obliged to prepare a master file. And if it exceeds 750 million euros or 3,250 million zlotys, then there's the obligation to submit a CBC report or a CBCP, which is a notification submitted if other entity from the group is obliged or responsible for CBCR. Next slide, please. And now let's talk a bit about the deadlines for all the obligations that I just described. First, we've got the CBC notification. This is 3 months after the end of the financial year. Then we've got the statement of the management board and the TPR form. And this is 9 months after the end of the financial year. What is important due to this statement, this is also the deadline for preparation of the local files and transfer pricing analysis. Second thing is that the local files are not submitted to the tax authorities, only just in case of tax audit they are submitted, and then the taxpayers has 7 days to submit those local files. And from the recent events, there is a proposition of the Ministry of Finance to prolong those deadlines. So for the statement and for the TPR form, there will be 10 and 11 months respectively. And to submit the local files in case of a tax audit, this will be prolonged to 14 days. And 1 year after the end of the financial year, the taxpayer is obliged to prepare master file and to submit the CBCR. Next slide, please. So, talking about those obligations, I have to mention what are the consequences for not complying with them. First of all, for diminishing of the taxable income, in case due to the application of non-market prices, the taxpayer is penalized with additional tax liability. But as I said, members of the management board are obliged to submit a statement. Due to that, there are also personal liability of them that comes from the fiscal penal code. So for failing to submitting after the deadline, or submitting a false statement, the members of the board are personally liable. And the most common penalty for that are the financial penalties. The value of those penalties differ year to year because this is based on the minimum wage in Poland. And as of today, this is up to 25 million zloty, which is approximately 5.5 million euros of a personal liability of the management board members. Additionally, if there are more crimes committed at the same time, fiscal crimes committed at the same time, there can be other penalties for the board members. So for example, if the taxable income is diminished and there was no statement, there can be also other penalties such as deprivation of the right to perform the function of a management board member or advisory board member in Polish company for a given time. And I'm giving floor to Artur.
Thank you, Jakub. Ladies and gentlemen, thank you for joining us during today's webinar. My name is Artur Klensk. I'm a co-founder and partner at Nodal Advisors from almost 10 years, and I specialize in transfer pricing issues for over 22 years. Now we would like to share with you our opinions on this controversial new regulation regarding tax havens. Of course, Polish tax administrations are, as other administrations, they try to fight with the tax havens. But we have an impression that sometimes they try to be a step ahead of everybody. So as you could see, there's a list of tax havens according to Polish regulations, which basically is 3 times longer than the list adopted by the European Union. And this difference has real practical consequences. Let's take, for example, Hong Kong, which is on the Polish list and not included in the European Union list. The practical consequence of this is that if Polish taxpayers buys something from Hong Kong, let's say services, these are automatically treated as transactions with tax havens. But this is not the only practical consequence. As the lot of trade, of global trade with China goes traditionally through Hong Kong, also these transactions will be treated as a transactions with tax havens by the Polish authorities. Next slide, please. These new regulations have, let's say, a couple of areas. One area is direct transactions with tax havens. So basically, they say if a Polish taxpayer has a direct taxation with an entity located in a tax haven, and it doesn't matter whether it's a related or unrelated entity, and such transactions of homogeneous nature exceeds slightly below 21,000 euro per year, these transactions falls under full transfer pricing regime that Kuba described. This seems quite straightforward and clear, so one may ask, where's the problem? And the problem starts with a definition of a beneficial owner. Our definition, which is included in tax regulations, is pretty much similar to other European jurisdictions. There are some let's say minor differences, and which are different from country to country, but they are not significant. The definition of the beneficial owner is traditionally used for withholding tax purposes, but for this new transfer pricing regulations, this definition is interpreted in a very broad nature. Next slide, please. According to this definition, any transactions concluded by a contractor of a Polish taxpayer could be treated as a transaction with a tax havens. This is very important, especially from the perspective of transactions between unrelated entities. And yes, this is true. These regulations included also in a transfer pricing regime transactions with unrelated entities, which is completely against the idea of transfer pricing. So basically, what does it mean? If a Polish taxpayer has transactions also of homogeneous nature with unrelated entity located either in Poland or abroad, and these transactions exceed in a financial year the value of slightly over 108,000 euros, the taxpayer should check whether such unrelated contractor has or not any settlements with tax havens. Any is very important word here, because it doesn't have to mean that there is a kind of a tracing of original transaction. No, when you have a transaction with unrelated entity and such entity realize any transaction with a tax haven, this original transactions falls under full transfer pricing regime. And for example, using this Hong Kong example, if Polish entity has an unrelated entity which buys, for example, spare parts from Hong Kong, basically from China through Hong Kong, no matter what the value of this spare part is, this transaction is treated as a transaction with tax haven. Second example, let's say that a Polish taxpayer buys consulting services from an unrelated entity located in Germany, and this German entity, as I said before, unrelated, has a loan from a bank which is based in Hong Kong. Such transactions also falls under this transfer pricing regime. Next slide, please. There are very practical difficulties regarding this new regime, which actually are commented as very controversial, both by the business and the advisors. First is a lack of tools which could allow taxpayers to fulfill these obligations. Second thing is a kind of an inbuilt assumption that every transaction performed by the Polish taxpayer with unrelated entities may be potentially transaction of shifting revenues to the tax haven. And the third thing is that also a kind of an assumption or our impression is that these new regulations impose more obligations on entities or with respect to transactions with related entities which have seats not in tax havens, that entities which basically perform direct transactions with tax havens. Next slide, please. Talking about these difficulties, there are at least two questions here. How Polish taxpayer can receive information from unrelated entity, whether these unrelated entities performs any transactions with tax havens. I'd like to underline this, that these relates to unrelated entities, and there are at least two scenarios here. First, we have an unrelated entity in Poland, and in such a case, it may be easier to fulfill this obligation because also this entity, unrelated entity, falls also under this new regulation. So mutual understanding could be easier to reach and to achieve a kind of a win-win situation. The different story is when Polish entity, Polish taxpayer has a transactions with unrelated entity which is located abroad, for example, in Germany, and how this Polish entity could persuade these unrelated entities to receive information about such entity independent transactions, especially that an entity located in Germany doesn't have to know the knowledge, doesn't have to have a knowledge about the Polish regulations and why it should be willing to provide such information. And I think it's understandable for such an entity why should provide internal information to completely unrelated entities. So basically, the conclusion, to some extent, the sad conclusion is first, we discussing with our clients these new regulations. We're trying to make some actions in advance, and first try to reach both related and unrelated entities, especially located in Poland, to ask contractors and unrelated contractors for such information. But on the other hand, if there will be no answer, or the answer would be to some extent doubtful, I mean, slightly sad conclusion is that probably just to protect the management board members, because as Kuba mentioned before, this full transfer pricing regime is imposed to unrelated transactions, but also penalties for non-compliance for the management board members. So in order to prevent or to manage the risk for management board members, which is our main goal, the conclusions probably be to prepare documentation, the statement, the TPR form, etc., just to avoid the risk of personal penalties. We, of course, monitor the situation. This is a new practice. These regulations are not big. There are just a couple of paragraphs, but the Ministry of Finance, for this couple of paragraphs, produced tons of pages of explanations, which doesn't seem to be going in the right direction. Basically, the recommendation from the advisors and the businesses to simply liquidate these regulations. We'll see what will happen, but I have a feeling that considering more and more fiscal approach and fiscal needs from the government, it would be rather difficult to achieve. And that would be it from our side. I hope it was interesting.
Thank you, Arthur and Jacob. I think there was a question about how to document such transactions, certainly with unrelated parties and penalties, but maybe we can. You have still some minutes, so maybe you could give some answer to that question at the moment. So how to what's the penalties you discussed already, the management board? Huh? But how to?
Yeah, sure. I mean, as Kuba said, basically, you know, the tricky part here is these penalties results from the criminal law, tax criminal law, which is quite specific, as always. This is not the thing that this will happen or this will happen. It depends on every single situation. But penalties which are included directly in the tax penal code, which is also tax crime code, they are just saying that if you do not provide a statement or TPR form in time, or you do not provide at all, or you provide a false statement, you are under penalties, these financial penalties for individuals, for the board members, up to this astronomical amount of 27 millions. I actually do not expect that such a penalty would be imposed, but up to 10 or 15,000 euros I could really expect. And the second thing is that if it will be combined with another action which could be classified by the court as a tax crime, they could impose a couple of penalties at the same time, including like the ban for the management board members to be in the, I don't know, supervisory board or management board in Poland for a couple of years, for example. Okay. And how to document this? This is very interesting question, because of course we basically the situation is that we have obligations, we have consequences for non-compliance, and then basically no tools how to check that, and this is a difficulty, but also no guidance on how to document it. So probably the standard transfer pricing regulation should be applied in this case. We are still waiting for any other, let's say, guidance on this respect, but it seems for now that simply full documentation should be prepared. There are some rumors that plans to probably exclude from this obligation benchmarking analysis, but this is not binding as of the moment. So we'll, as I said, we'll monitor the situation, but I guess my personal feeling is that the biggest difficulty here, especially relates to unrelated transactions for the companies which are not members of capital groups, because transfer pricing is, you know, traditionally is off the radar for such entities, and the awareness of this regulation is not so high in Poland. We have tons of discussions with clients and from entrepreneurs, and we have a feeling that this is not the thing that everybody is aware of that.
Okay.
So yeah.
Thank you, Arthur. And then okay, the question came up, and therefore my intervenence. And when we go to Klaus and Oliver on Germany, and maybe I believe Klaus, you would start. Okay.
Yes. Am I live? Am I live? I don't see it.
Yes, you are.
Theo, you're live. Yes. Oh, okay. Good afternoon, ladies and gentlemen. My name is Klaus Dorner. I worked for nearly 20 years in transfer pricing consulting in Big Four, and last year I started my own business, and since this year I joined the Quantera Global Network. Today, I would like to give you a short overview of legal changes in Germany. After completing the OECD BEPS project quite a few years ago, we had now over, let's say, 2 years discussions about how the German core norm, next slide please, the German central norm on the arm's length principle, which is paragraph 1 German Foreign Tax Code, should be redrafted in order to assure consistency with international standards, and which was also an intention of the German tax authorities, where no clear international rules exist, to make an own point. There were quite a few drafts, redrafts, changes back and forth, and in the end, last Friday, for the last changes, the Bundesrat, which is the German second parliamentary chamber, finally approved. So we now have the final version on the table. The changes to that law focus on section 2 and 3. What does the law effectively say? And this has not changed. It says if a German taxpayer is involved in a business transaction, cross-border business transaction with a related party, cross-border means outside of Germany, and its German income is reduced by non-arm's length conditions underlying this business transaction, then there should be a respective income adjustment. This is effectively said in section 1, and the other sections, which is 6, altogether define certain details on that. For example, what is related party, what is a business transaction, and so on. So what has changed is section 2, the definition of related party. I will go to this shortly now, and then section 3, which is the core part, the sections on how should the arm's length principle effectively be applied during the analysis. Next slide, please. Thank you. And at the end, I will also shortly go into some points which have not made it into the law text, but I nevertheless feel is important. So relatedness. The German rules effectively are based on 3 pillars. That means a shareholding of at least 25% in the other party, some other dominant influence or an identity of interest in the profit of the parties. I think in most countries it's very similar. Maybe the 25% threshold is different. What we have now here is that in order to avoid certain, let's say, avoidance schemes based on, for example, issuing shares with no voting rights or multiple voting rights and hybrid financing structures and so on, to fill a gap, at least an assumed gap, in the way that in the future, that means from the financial year 2022 on, relatedness is also given if a company has at least 25% entitlement to the profits of the other company or the liquidation income. So even if the shareholding is lower. That's something that should be considered if you have special structures which are, let's say, non-standard. On this slide, it's mentioned something about network organizations. I would like to come back to that at the end with certain points that are not in the law text, but nevertheless, I think in midterm or long-term relevant. Next slide, please. Now let's come to section 3. As I said, section 3 defines how the arm's length principle should be applied. The first change is that this section 3 has been cut into pieces. It has been cut into effectively 5 pieces, if I count correctly. That is, section 3 has been changed into 3, 3a, 3b, 3c, and a new paragraph 1a. The total story as such has not changed the transfer pricing world. The point is the change in wording is not necessarily identical with the change in meaning. We have sections which are redrafted in wording, but the change in meaning, at least based on my opinion, is not that relevant. On the other hand, we have very slight changes which might make a bigger difference. So the new section 3 is effectively, let's say, the general part. And the general part says the basis for any arm's length analysis shall be the factual circumstances. That is the actual business conduct of the parties based on a functional risk analysis. This is new to the law. It's not totally new in a black and white situation. We have substance over form rules in Germany for a long time, but this clear statement is a significant change by saying we don't care about contracts too much. We may look at that, but it is important to go into the real conduct of the business parties. And this will be something where my colleague Oliver Treitler will, in the context of administrative guidance, which has been issued last year, pick up again, because the question how to get the information about the real business conduct at the point in time when the transaction was concluded, that is agreed on. That's something that will be very important for taxpayers, for tax authorities as well, and to make sure that you have the chance to position yourself and to make sure that actual business conduct, contracts, methods applied and so on are really consistent. Based on this actual business conduct of the parties, also new is the change from a method catalog for a transfer pricing method, including a hierarchy, to the requirement to perform a best method analysis. So all in all, we have at least a trend to a more reality-based, economic, rational approach, which is good. On the other hand, everything becomes also, let's say, a little bit more fluid and unspecific, so that the information on the facts and also deliberations about what is the best method, what is the better method, and so on, becomes more complicated and more disputable in the end as well. Next slide, please. So Section 3A continues the story by saying, well, after having identified the reality, having performed comparability analysis, having applied certain methods, having created data, the result is usually a range. This section has been largely redrafted in terms of wording, but ultimately I believe it has not really changed the rules effectively. What is disappointing here is, as I believe, that in that section it said, if you're outside the range, the adjustment needs to be to the median, which is as we had it before. But we had quite a few years ago the Hornbach case at the EU Court of Justice, where it said that rules like this, which are effectively anti-avoidance or anti-abuse rules, should give the taxpayer a chance to substantiate reasons, economic reasons, why he does not conduct in line with the arm's length standard. I hoped that something would be in that law where the German tax lawmaker would pick up on that, but nothing in the whole law is nothing about that. And there is only some exceptions by saying taxpayers can substantiate something other than the midpoint of the range, but effectively it's like it is, although the wording is different. Please, next slide. And in 3B, we come to the restructurings, business restructurings, the so-called transfer of business functions, which is something we had since quite a while in Germany. Here we have two changes effectively. One is a methodology change, which is linked to the stipulations on how a hypothetical arm's length test is to be done. We had very specific, let's say, tax valuation procedures in the law, which have been problematic in one and the other way, which is abandoned now. The new rules simply say that a hypothetical arm's length test should be a two-sided test, considering the seller and the buyer's side, should be based on full transparency, on all relevant facts and circumstances for both sides, and should be based on economically well-accepted valuation principles. That's also, as I believe, very good. Will, on the other hand, obviously also trigger some discussions about which methodology is the best one. The other thing, which is only one word, you see it on the slide, it's bold, is a change from an and to an or. It might sound philosophical, but in my career, I had quite a few cases where we used that old and to defend our clients against the tax authorities. What is the story behind? The definition of a transfer of business functions as it was the transfer of functions, chances, risks, assets, and other advantages. Other advantages shall cover things like business opportunities, goodwill, all these other things that might not be an asset. And means, in order to fulfill this requirement, both must be transferred, not only one of that. And whenever we were able to substantiate that, for example, no intangible assets have been transferred or no other advantages, which is very fact specific and case specific, we claimed, and we claimed successfully, that the requirements of the definition of a transfer of business functions triggering the specific rules on that were not fulfilled. Obviously, German tax authorities were fed up with that type of argumentation. I was certainly not the only one doing that, and wanted to get rid of that and change the and into an or, because or does not require that both applies. You should consider that if you are in a situation that applies for that. Please, next slide. Next slide, please. Yeah, thank you. Section 3C is now really new. It consists of two parts. The first part is a legal definition of intellectual property. What's important is that it is not talking about intangible assets, but it's talking about intangible values. Again, we're a little bit in the field of philosophy, but I feel that this is a wider concept. And when you read the definition, which I will not go through here in detail, it effectively encompasses more or less everything that is not a tangible asset, which is not a shareholding asset or financial asset. So it's a very, very wide concept. And based on that, we have the legal implementation of the OECD DEMPE concept, clearly stating that the income out of a piece of IP shall be allocated based on the so-called DEMPE function: development, enhancement, maintenance, protection, and exploitation. Meaning that, which is different to the past, that ownership as such, or at least illegal ownership as such, should not give entitlements to profit from the IP, piece of IP. This might also have implications to other discussions. We had certain withholding tax discussions and so on. It also clearly states that financing DEMPE functions, so providing the funds for performing these functions, is not a DEMPE function in itself. Whenever the function only is limited to financing such functions, then this is a financing function and that's it. That means you get an interest for that, but no part or portion out of the income from the IP. That's the DEMPE concept as we know it from the OECD. I think it's good, but on the other hand, it's also difficult to implement when you look, for example, global matrix organizations, and in order to really check out who is providing what and to balance these value inputs. Thank you. Next slide, please. So, and now we have the last part of the changes to 3, which is obviously not a change to section 3, but it's a known paragraph. It covers with price adjustment clauses. We historically had in the connection with this transfer of business function rules. Now they apply to all transactions, including intellectual property, IP. So the scope of our application is widened to all IP transactions. And the basic idea is to say, if the transfer price is recalculated based on hindsight information, and the transfer price that it results from that recalculation is significantly different from the originally agreed and paid transfer price, then there should be some sort of a retroactive adjustment or an adjustment in the next year. Historically, as I said, this applied only to transfer business functions, and we had a 10 years consideration period. Now the consideration period as such is reduced to 7 years, but we have a quite restrictive, as I believe, restrictive rule on what is a significant deviation. The significant deviation is given if the recalculated transfer price based on hindsight information deviates more than 20% from the original one. And when you look at asset valuation, company valuation procedures based on planning data for quite a long, based on quite a long time horizon, 20% around the original price is not a lot. I believe this is a rather restrictive regulation. Insofar, it is very important to have a look at the escape clauses. The escape clauses provide for 3 cases where this does not apply. Number 1, if the developments that are the reason for the deviations are unforeseeable developments, whatever that is. Maybe COVID-19 could be such a development that was not foreseeable for both parties. Number 2, if the taxpayer proves that the uncertainties which have materialized now in the figures have been already properly considered in the valuation as such. So, for example, uncertainties that are covered in the discount factor as a risk premium and so And third, if you have some sort of a self-adjusting mechanism in the price scheme, so in the form of a sales or profit-based license. If that's the case, then the adjustment rules should not apply. So this is a very short overview of what has been done out of the old Section 3. And now I would shortly cover at least two things that have not jumped high enough to make it into the law text, but should not be remain unconsidered. Next slide, please. The one thing is we should wait for the decree law. In Germany, we always have effectively decree laws specify the details. That's yet to be done. The existing decree law does not apply anymore because the underlying law is significantly redrafted. So let's wait for that. It should also be mentioned that we now have a legal basis for APAs. And the interesting thing is that these rules, the legal basis for having APAs, grant a discount on the APA fee if the APA is related or linked to a joint audit. I understand that as a message to booster and to incentivize joint audits, which is obviously an own topic we could have a webinar on, very interesting, but I think that's an interesting message. The 2 points I would like to go to is number one, another element of being related. We had quite a discussion on, and it's still in the side documents to the new law. We call it the Gesetzesbegründung. I don't know exactly how to translate that into English. The idea that from a legal perspective, unrelated parties who work together in network organizations in a way that this is, from a business perspective, strongly integrated, that such organizations should or may be deemed to have a joint interest into each other's income, so an identity of interest, and therefore be considered to be related parties in the sense of the law. This has not made it into the text of the law, but it's still, as I said, in the Gesetzesbegründung as an idea. It might come up again. And who is working in something like that, franchise arrangements and so on, should be a little bit careful on that. Because tax authorities have made clear that in such modern, let's call it modern, business models, they often see significant payments in terms of service fees, license fees, franchise fees, and whatever they would like to have a little bit more control on in order to apply, or by applying arm's length principles. That's the one thing. The other thing is that the original plans for changing Section 3 of the German paragraph 1 of the German Foreign Tax Code also included very aggressive, asymmetrically, and also implying treaty override, specific rules on intercompany financing. These rules have not made it into the law, but they have been supported until the end of the parliamentary discussion by the Green Party. These rules are really a problem for many if they would apply. It is not unlikely that the Green Party will become part of the government in Germany after the next election. And since these ideas have been so intensely discussed, I would be very hesitant to exclude that it will come back in a future legislative initiative. And since transfer pricing is a mid and long-term system design topic, everyone should have a look at that. What does it mean? What is the basic ideas? And it also is in line, as I believe, with the DEMPE concept and the statement that financing should not give rise to income from the IP, in the sense of that it is clearly visible that German tax authorities try to make sure that financing services, in the case of DEMPE, financing DEMPE functions, in the case of this, acting as a solicitor, as an agent, as a cash pool master, all these functions should not earn high profits. That's something as a basic message, and obviously it tries to come up again and again, and I would personally assume that sooner or later we will have something like that. Maybe a little bit weaker in order to avoid treaty override, but we will have that in German law in the future. Thank you, and now I would like to give over to Oliver Treitler.
Thanks, Klaus. I'm Oliver. I'm a Berlin-based transfer pricing advisor, and I'm with Conterra now for 3 years. I'm very happy to join this group for today's occasion. I'll just try to elaborate a bit and take off where Klaus left off by tackling the issue of administrative principles. So Wouter, if you could directly jump to the next slide.
That's not the next.
No, that's not the next one. Yes. So why are administrative principles interesting for us as TP practitioners? So essentially, they provide the mandatory framework for the auditor to operate in an audit situation, and they provide much more specific details or interpretations of the law that Klaus just outlined. And for the tax administrations for the auditor, those are sort of binding regulations, and they impact a lot of audit relevant situations and aspects, such as the burden of proof, the competences the auditor has in making adjustments or assumptions, requesting evidence, and so on and so forth. So it is quite interesting to also contrast different approaches how administrative principles can be worded and structured. So what we want to do in the next maybe 5 to 10 minutes is contrast Germany and Austria. So essentially both authorities had the same task. So they had to update their administrative principle to kind of catch up with the changes in the laws and the changes brought on by BEPS. And looking at those regulations side by side, and you'll find links to the documents in subsequent chapters, and reference some of the paragraphs. It is quite clear that Germany did decide on a rather restrictive approach. So coming back to what Klaus said, he said, yes, transfer pricing in Germany is going to be more economics based, more factual based, which is certainly true. And one has the impression that the German authorities kind of are not feeling very comfortable with the fact that they will be confronted with factual based documentation. They have to do a lot of analysis on the functional and risk analysis and so on and so forth. So when you go into the details of these administrative principles, the relevant changes that you will see, and those are not like earth-shattering changes, sometimes very small wording changes as well, similar to those that Klaus highlighted, is that you'll find that the German auditors will have more leeway in actually requesting information to substantiate this economic reality. So a lot of, let's say, of the new adjustments have the effect that the taxpayers will be in the position that they face a higher burden of proof. So they will have to provide additional documents. They have to provide evidence that is not even only related to the method they apply, but maybe to a method that the auditor would consider relevant. And this directly ties into the first point here. So as Klaus said, there are changes in the law addressing the hierarchy, aligning this with the OECD guidelines with the best method rule. This is true, but when you look into the administrative principles, so how does it work in practice, the taxpayer is certainly still in the position to choose the preferred method, but there's a sentence in the administrative principles stating that the auditor or the financial authorities will determine what the correct method is, which kind of reverses the tables for the taxpayer insofar that now, even though he's under no obligation to apply a second method on his own, he must comply, and this is stated here in the middle of the slide, he must provide evidence or procure data for the authorities to validate his results by alternative methods. And this is, in my reading, quite a, I mean, this discussion sometimes came up in earlier tax audits, but now having the administrative principles in place, that's a for practical purposes, a much stricter environment to operate in, and the data or evidence that is required and those references made here are essentially modifications of the existing principles. So they go far beyond just transfer pricing methods. They go adopt for cost accounting, cost charges, sales data, and so on and so forth, right? So this enhanced cooperation requirements is really something that I think reflects, maybe illustrates this German approach of being quite concerned that they want to have all the data available to check these economic facts. And what is striking is when you look at Austria, seems to be quite a contrast. So Austria is seem to be very laid back and very close to actually mimicking the OECD guidelines. So looking at the OECD, at the Austrian administrative principles, they have 270 pages, and most of the, let's say, compared to the Germans, they are relatively short. So we're talking like 30, 40 pages, but the Austrian principles, they have a lot of examples. They have a lot of direct references to the OECD guideline. They go into a lot of details, explain how the profit method works. Like this is post-BEPS method that seems in Austria to be, let's say, getting more attention, and they get more guidance, which is very much aligned with the OECD. The German administrative principles are, let's say, very, very national. They have a very strong national connotation, even post-BEPS. So this is sort of a disappointment, and at least in my view, that Germany could have, and this is for a German not easy to say, but could have followed a more Austrian approach and just say, okay, we don't need so many, let's say, national safeguards applied. Let's just be more brave or more open to just follow the OECD lead here. And I think some of the was also showing through in what Klaus said. So a lot of the German views on this transfer pricing issues that are related to financial transactions are of the anti-avoidance variety and not so much of the let us find a pragmatic way to apply arm's length principle. The last point here is structure and clarity. What I already mentioned, the Austrian principles are more comprehensive, but this is one document. You can find all the information. It's essentially very much looking like the OECD guidelines, whereas when you now operate in Germany, you have to mix and match through 3 separate documents. So you have the old administrative principle in 2005, which are not completely irrelevant with the new guidance in 2020, because some of the paragraphs remain valid, especially those on benchmarking and so on and so forth. Whereas concepts such as DEMPE, they are not included in the administrative principles, but as Klaus said, they're in the foreign tax code. So you will have to kind of mix and match or see what is relevant, which is just, I think, from an administrative point of view, not very convenient. Wout, next slide, please. And maybe also here, coming back a little bit to the economics side of it, and the functional and risk analysis is certainly front and center of this debate. Here, I would extend some credit to the German tax authorities. They at least went through the effort to provide a, let's say, example of functions and risks they would expect a taxpayer to comment on and to include in his analysis. So this, for practical purposes, might serve as a value guideline that was missing before. So this is at least something where I guess as a taxpayer you get a little bit more of an impression what is expected of you to do here. And it might be quite a valuable source of reference in an audit situation. Again, Austria, I think, is even here the stronger country insofar as one thing that was very dominant in the OECD reforms of the OECD guidelines was the concept of risk. And of course, that matters a lot when you talk about economic reality. So who actually manages and controls risk? I think the German administrative guidance is very light on this issue. It's almost non-existing, whereas the Austrian administrative principles are essentially mimicking, again, the OECD, but provide very, very detailed explanations to this. And The other issue, which is always on the agenda here, is this price setting versus outcome testing. And again, Klaus kind of foreshadowed this, and it's not a surprise that, and this goes for both Austria and Germany, both of these countries are strongly focused or prefer this ex ante price setting approach as opposed to the outcome testing approach. So again, when you read through the administrative principles, you will find a lot of let's say guidance or information that you are supposed to make all the effort you can as a taxpayer to ensure that the documentation available at the time when the contract was concluded, at the time when the pricing was agreed, is actually reflected in your documentation. So you're not getting off the hook by just, you know, retroactively applying the TNMM, but you really would have to procure a lot of data, and the tax authority now, based on the new administrative principles, certainly in a position to demand this to be shown and disclosed of what happened in the price setting stage. And yeah, year-end adjustments, they are essentially following the EU Joint Transfer Pricing Forum best practices on this, but again, with quite a restrictive approach. Yeah, both of course need to have contracts, but now, as Klaus mentioned, they will have a contractual analysis, but it's not anymore the case that just having the contract will be sufficient to justify allocating residual profits to certain parties. I guess that's the main message here. And then for the benchmarking, as Klaus said, I mean, for the tax audit purposes, I would just add that the practice was, of course, interquartile range was very much the main mechanism used, but there was up till now in Germany no need to apply the interquartile range, or you were completely free to argue or make the point that a different percentile would be more appropriate for the case at hand, which knowing how benchmark results shake out, you a lot of times are in a situation that the interquartile may not be the one that you consider actually ideal. And the new law, you might say, brings clarity. So IQR is needed, but it really cuts back down on the flexibility when you apply target margin systems, and taxpayers applying target margin systems that are operating maybe a little bit on the fringes or even outside of the interquartile range. They might really have to take a very close look on the sustainability here. So I was sort of rushing through this, but I hope this at least provides a flavor on where the regulations or administrative principle on the ground are getting stricter and stricter. And then I would defer to Theo.
Thanks to you all. I think highly interesting, and we could have a discussion for more than days on the topics, because there's a lot behind and to be said about it. But I promise to keep as close as possible to the 1 hour. So that gives me a couple of minutes to give you some flavor about the Netherlands. I think in the Netherlands always we're close to the OECD guidance, and didn't have too much tax law and specific Dutch definitions, but tried to be as close as possible to the guidance, international guidance. And that led to a lot of highly professional discussions, and also with the Dutch tax authorities on a high level on TP. But we were penalized about it a couple of years ago, and that led to a change on the political landscape. It's more focused on being international acceptance, and that led to change from merchant to pastor. That's something we say in the Netherlands, that it was more going out to make it work and the business work, and more now to go to documentation and to formalities and legal aspects. And that's something what's really is a change. It's not that is completely different, but for me, I'm now 30 years working on transfer pricing, on 10 years as head of taxation, 7 years in tax authorities, and now the last part of the 30 years as an advisor. And that's something that's really is a trend in the Netherlands. that we are more and more going to documentation, and also that the tax authorities are more aggressive in audits, and we even have more penalties than in the past. So it is as if we are going to more close to other countries in that field. And also it's changed in 2019 already, but it impacted a little bit how to get certainty in advance. Certainty in advance, like the APA practice, even more centralized. And we have now a college of seven specialists who have to approve the APAs. In the past, we had somebody that overlooked all the APAs, had to co-sign the APAs, and now there's a college of 7 people, and that shows that we have made some investments in the compliance and the formal procedures. However, and therefore I made the last comment, that these tax authorities, but also the APA teams, are highly experienced and still are very transparent and capable to discuss on the content and realize solutions within the international guidelines. So I will not have a lot of definitions and laws with all specific Dutch elements, but I think if you look at the OECD guidelines, that we are very close to them as well. So we have to we adjust ourselves to the international context on being formal, okay, transparent, etc. But that doesn't mean that we can't have a very good discussion and alignment with the Dutch tax and the APA teams. So, I'm happy to say that we were the first one to conclude in the so-called Corona APA in the Netherlands just recently on the effects of Corona in the APA practice, and that says that we still can do something there. Okay, next slide, please, Wouter. Maybe something on the documentation itself. We had documentation requirements by law since 2002, but after the BEPS project we made that we will follow the OECD requirements on master and local file if you have 50 million euros of consolidated turnover. So consolidated for the whole group. If you have 50 million or more, you need to have the master file and local file. And 750 million or more, then you have the CPCR filing is required. I think that's that last one is more international, the requirement. You have to have it on the moment that you file your corporate tax return. That's more or less the moment that you have to have it in your administration. So you don't need to send it in, but you need to have it in administration. And penalties came also on board when these kind of requirements were put in place. And that was a revolution for TP in the Netherlands, but before TP and penalties were something seen as not to be aligned, because transfer pricing is so much, you can discuss on it and there's so much range in it. That's why should we do the penalties, but that's in place now. And I think that's what I would like to say about documentation, because like the second bullet, we are always focused on relevant facts and circumstances, so economic reality. Obvious, the formal and the company agreement is the basis to start to understand what parties agreed upon, but we always said that the relevant facts and circumstances, economical way of looking into what's really happened, is a real basis for a transfer price discussion. Yeah. Okay. Maybe next slide, Wouter. Yeah. All said, TP risk management is becoming even more complex also in the Netherlands, because, like I said, APAs are more formalized, certainly in advance. So you have to go more for robust TP documentation, because the APAs, certainly when you have tax havens in place or non-cooperative countries, are not possible anymore. And therefore, you need to look at what is your position in the Netherlands. The documentation robust is important. The APAs are more aligned with the OECD in the sense that economic nexus is really of importance. You have to have the relevant substance in the Netherlands to get certainty. And low tax and non-cooperative countries, I have a list in the next slide, but maybe only will show it. And if you are there and there's below it, you are not applicable for an APA. Maybe go back, Wouter, to the former slides. So, but it is still possible. Like I said, we had the first Corona APA concluded as Contea Global, so we are very proud on it. But that says it is possible, and we recently had a very highly complex APA concluded in these times. So it is not easy, but it is still really possible to do it. And as a last point, what I see more and more, that we have, and I believe that Klaus mentioned it already, we had in the Netherlands also a growing interest in bi- and multilateral audits. Today we had a discussion with the tax authorities on a multilateral audit, with I believe 5 or 6 countries included. So you also have to understand that if you do a risk management on TP, that is possible that the country asks other countries to look into your TP policy and result allocation. And that is not that you can ask for it. It is also possible that you ask countries for such an audit, but some countries can also, like the Netherlands, decide that they want to have a more overall picture of your facts and how countries look at it. And that gives not only more transparency, but also a bigger playing field, I think. And that's coming to us very rapidly. Okay. Next slide, Wouter. I think this already was mentioned with everything in it. Then I would like to conclude with the takeaways from the Netherlands. Really what I see that the Dutch tax authorities are more aggressive in audits. And that's also because they are penalized a little bit about giving certainty in advance, but not looking at the real situation. That's always a matter of capacity, of how much audit capacity resources a country has on those audits. But we are seeing that they are more going to audits and more aggressive. I think in the Corona time we saw a little bit decline of it, and that's obvious. You can't go to a lot of companies for an audit, and people are working from home. But we are really looking into, I think, coming years for more audits coming along and more questions. There is also growing awareness of international political pressure, and the Netherlands is a front runner, what I call BEPS 2.0, but also what happens on ATAT, etc. We have a growing interest in discussing that international and also with the audits. I already mentioned that TB documentation is even more important in the Netherlands. It is not about paper alone. The paper should also have your story in it and your defense. So compliance is not sufficient that you have paper, but that the paper already defends you towards an upcoming audit or questions. And the last, I have to say it, I was former head of the APA team in between in the Netherlands. So the DTA is still highly professional, and if you want to have a very risk management in the Netherlands, then looking at the possibility of an APA is still something that really is advisable and also done still a lot. So I think that's something very specific for the Netherlands and the APAs in the ruling practice, and there's still something really to look into if you think that you would like to have some parties giving you certainty on your position. And when you saw to Poland and Germany, Austria and the Netherlands, such certainty in these times of all kinds of questions coming up can be really valuable. Okay, and that's from very quick and reference of the Netherlands. I hope that gives you some insights. I would like to thank Arthur, Jacob, Klaus and Oliver in the preparation of it. I think we have a very solid and good partnership, and together we can do a global coverage, and we know the specific of a country. This webinar will be recorded, or is recorded, can be received by a link. I think that everybody will receive an email about this with a link, and can then get into the presentation and also the recorded webinar. And if you have questions, and I just had a question about European Court of Justice, we will come back to that question separately, and would like to thank all who are still with us. I see that it is going down now a little bit with my final remarks. So I would like to conclude with thank you all, and I hope that we can see each other again face to face sometime early. Yeah? Okay, bye bye and thank you.